one of the things about auditing is a lot of times when something does go wrong, you get called in. And they'll say, hey, we have this thing here and it's, we had a theft or we had a whatever go wrong and they want you to come in. And this is a case that's kind of based on the stuff that you'll find on the CFE exam. But anyway, go ahead and read through it. It's not very long. But read through it and then we'll kind of go over it then. Oh, I didn't put this in the shoot. Oh, I didn't put it. It'll be in your email. I didn't put it in Blackboard yet. Nope. Take a second to load them up just to. Okay, so they had a theft of shipment of expensive running shoes. And they had a shipment come at 10 a.m. The 4 p.m. the shoes were on the floor. And the register tape showed that none of the shoes had been sold. 2 salespeople, both of whom were unsure if the shoes had been put on the sales floor. Okay, salesperson A. Angrily replied, "Are you kidding me? This is BS. I've worked here for 5 years. If you think I stole a stupid box of shoes, then you're nuts." Salesperson B. I could have taken the shoes. I was in front of the store all day with the customers. Look at my register tape. My sales are all shoes from the front of the store. The customer probably took the shoes while we were busy with other customers. Added. Okay, which one would be the most likely suspect? In hindsight, I should change A should be salesperson A and Well, we'll just go with this. Oh, that would fit perfectly too. I should have switched these so C would be customers. But anyway, so A, is it the customers? B, salesperson A or salesperson B? Which one do you guys think? Now,
A.
could be. The only problem with A is it looks like it was, they don't say how many was in the shipment. But it could have been. There would be no proof on it. But which one I hear is probably the most likely?
I will say the sales person B.
Yeah. Salesperson B is probably the most likely one. And that's one of the weird things about, trying to figure out, by the way, you wouldn't know unless you investigate further, but whenever you're called into a situation like this, you kind of look at, where's the most likely suspect? Okay. The anger is the normal response for somebody that's accused of doing something they didn't do. So when if someone's accused of something that they didn't do, they get really mad about it. And they usually just don't want to talk to you about it. So salesperson A is the normal response that you'd expect from somebody who didn't do it. Doesn't mean that salesperson A didn't do it, but it's a response that is the normal response is anger. Okay, let's go to salesperson B though. I could have taken the shoes. I was in the front of the store all day with customers. Well, remember, they didn't even know where they were, if they were on the floor or not. So this seems to be an explanation of somebody who may have known where they were. My shoe sales were all in the front of the store. A customer probably took the shoes while we were busy with other customers. People who are, well, first of all, it does seem strange a little bit that the salesperson B would have an alibi. It's very strange to have somebody who knows exactly where they were at what time. If I were to ask you, where were you last Thursday? Well, I was at work. What did you do there? Worked. What was you for lunch? Ate it. You generally don't. A lot of times it's not right on the tip of your tongue. But another thing is that people that commit frauds and stuff like this is that they will use vague terms. Probably, maybe. They're trying to give other alternatives to, for people to look at. They generally don't use definite terms. They don't use a customer took them. I saw the customer. You don't get that. Probably this, or maybe this, or maybe the driver didn't drop off the package, or what. They'll start giving alternatives, but they'll always be in vague terms. Probably, maybe, that sort of thing. Besides, I already have a pair of those shoes. Which just shows, that they like them. They already have a pair of them. But and also the thing, why would I do this? Another thing that is common in these kind of cases is that they will try to have you explain their non-rational, their irrational actions. Why would I do this? Why would I steal this? I'm making $60,000 a year. Why would I say, it's putting it back on you to explain their irrational actions. And a lot of times, things like thefts and all those things are not rational. People have lost. I did when I worked at US Steel. we had 6 people that were let go who were making over $100,000 a year because they were stealing, $300 or $400 a week. It isn't rational a lot of times, but a lot of times they will make, they'll try to get you to explain their irrational actions. Why would I, X? Okay. So yeah, the most likely is going to be salesperson B. Now, again, until you looked into it, you wouldn't know that, for certain, obviously. But this is more likely ones, people that have ready-made alibis or explanations. That's kind of rare. They speak in vague terms, things like probably. And this one is very common. Why would I take them? They put it back on whoever's questioning them rather than giving, an explanation that's feasible. Okay. Another thing about fraudsters, which by the way is the coolest word in the world, fraudster, but is that they are very different than your normal criminals. If you look at them in you look at a normal prison environment, people who commit fraud are way different than the rest of the criminals. And it's also true in companies that the people who commit fraud are way different than what you would expect. Okay, which of the following is a characteristic of a fraudster? Highly respected?
Yes.
Yes. Committed a violent crime in the past?
No.
Nope. Committed a fraud crime in the past?
Yes.
Yep, it's a repeat. Fraud is one of those crimes that people repeat. Again, I think only sex offenders have, a worse record on repeating the crime. It's one of those weird things. You'll see people that get caught doing something, they'll go to jail for 3 years, tears, everything. My family would have gone through it, and then a year later they're back behind bars. It's one of those strange things. Highly religious?
Yes, there's so much fraud in churches.
Well, there is, and part of that is that there's separation of church and state. There's no one's gonna, unless the congregation or whatever wants an audit, a lot of times it doesn't happen. But now it doesn't mean that someone who's highly religious commits a fraud. It doesn't go both ways. But one of the strange things about it is a lot of times there are people that they'll go to church 3 times a week and teach Sunday school and all that kind of stuff, and those are so I guess when someone says well, I'm religious, I wouldn't do that. A lot of times that's actually an indicator. Young?
No.
Not usually. Middle-aged? Yes. New employee? What do you think? New employee, are they going to commit a fraud?
No.
No.
Not usually. Old employee?
Yes.
Yes. Friendly? Yes.
Yes.
Extroverts? Yes. Punctual? Yes. College educated? Yes. They are very different from your normal prison population, from people who commit crimes. They're very different. And you say, well, what does that mean? That means, someone like myself would be the most likely candidate. And actually, it actually does follow. College students are more, and college educated people are more likely to commit crimes. We are, if you look at the overall profile, are more likely to commit frauds. Now, doesn't mean that all of us do commit frauds. Sometimes I don't, but But yeah, it's just one of those things. And, you know, they're usually not violent. They're usually very friendly. A lot of times, you know, they're the most liked person in the place. It's not unusual. There was a, when I worked at Navistar, we had I don't know if it's still there now, but there was an engine plant in Melrose Park that we had there was a secretary there who had worked there for like 40 years or something crazy length of time. And she would, whenever there was a stray check that came to the plant manager's office, she had set up a count. They don't even know when she set it up because it was set up before they even had computerized records. And she set up this account, and, you know, 5 or 6 times a year, there would be a stray check that would come in. She'd write a memo to the accounting department, sign the manager's name, which wasn't uncommon, and put it in there, and then take the money out of it. And
What's a straight check?
I'm sorry, a stray check. I mean, like an unusual check that doesn't come through the normal channels.
Gotcha.
For instance, if let's say that a trucking company, one of their trucks damaged a loading dock, you know, maybe they okay, our insurance will pay for it. You know, that check wouldn't come through accounts receivable. It would just come, you know, they just send it to the plant. So checks like that, you know, and maybe for a few $100s or $1,000, whatever it was, you know, she would just take them and deposit them. And people at the bank all knew her. They loved her. You know, hey, it's Alice. And yeah, so whenever there was a check that didn't come in, that went through, you know, the plant manager's office. And by the way, she'd worked for, I think, 3 or 4 plant managers. It wasn't just one person. There was a number. She was there for like 40 years. I think there was something like 6 financial people that came through. And the last guy that caught him there, he was in the bank and he was trying to get, he was new and he was just trying to get all the accounts because he was trying to figure out all the accounts and where they go to, and was talking with them. They said, "Oh, you just missed Alice. Yeah, she just made a deposit." "What do you mean Alice made a deposit?" And started looking at this account, and it literally went back so far that they didn't have records on when it was even started. She was like 60 some years old, and you know, they I think that they just said, "Look, you got to retire." And I think that, you know, she was, you know, well, you know, in the retirement age. So she did, and they had no idea exactly how much. It was in the thousands though, how much she saw. But again, nicest person in the world. Everybody knew her, everybody loved her, you know, and this went on for at least like 20 years. And who knows when it started. But anyway, very strange, you know, and you know, so it is hard to find, you know, people who commit fraud are very similar to the best employees you have, right? So it can be a little bit difficult sometimes to identify who's just the top employee and who's actually committing fraud. Okay. Let's go to, I think we got to finish the monetary unit sampling. Or did we? Oh no, okay, here we go, we stopped. Okay, so it looks like problem number 5. Let me kind of show you what is kind of going on here with okay. So it's sort of like this. All right, I gotta back back here for a second. Okay, so the client says that has a book value of 6 million. And our best estimate is that this is off by 40,000. So the projected misstatement is 40,000. And this is our best estimate. About what it's off by. Is 40,000. So, we're saying that this is off by, that's our best estimate. But now, remember, this is a sample. Now, it's only for understatement, so we're not going to have the front, the top. We're just going to have the one-sided tail thing go down and say, okay, this is down to the 5% level. There's actually two more things that can come into play. And they are basic precision and the incremental allowance. So basic precision and incremental allowance. So these are the other two factors that can come in. So basic precision and then the incremental allowance. Explain what these are. Ooh, is that too dark? No, doesn't look too dark on the screen. Okay. Basic precision is if there are no misstatements. Incremental allowance is when there are misstatements. So if you didn't have any misstatements, it would look like this. But if you did have any misstatements, there'd be this extra amount on here. And the idea is if there are misstatements, that means that misstatements are possible and that those will increase, the possible worst case scenario, which we call the upper limit. So the upper limit will be this 40,000 that we put that in there. This is our best estimate what's off by, but it could be off by a lot more because this is a sample and we're going to have the one side, the one tail test for to see what it could be off by, more than just the 40,000. So these are the next two things we're going to cover. One is real easy and one's a real pain. Okay, oops, where am I at? Okay, so we did this. If you don't have this, make sure you get this in here. This is the, I think it's from 3 weeks ago. And again, this one's an understatement, so we just ignore it. So this is our projected misstatement, 40,000. Basic precision. I think I'm going to cheat. Copy this. Oh. Just to get a little closer. Yeah. Okay. So basic precision is this. Boy, did I make that up? Let's shrink that down a little bit. What I did here. Oh, I got it. Okay, here we go. Okay, basic precision equals the interval times reliability factor. Okay, what's the interval?
$50,000.
Yep. So 50,000 is the interval. Times the reliability factor. And the reliability factor, let's see, this is at 5%. So I'm going to come up here. Row 0 is used for sample size and basic precision. So row 0. 5%, and the factor is 3. So we're going to multiply it by 3. $150,000. So this let's make it reddish. These are basic precision. Okay, now that the basic precision is if we didn't have any errors. If there were no errors, we would still have misstatements. So because this is a sample, it's not 100%. Our best estimate is 40,000, but it could be off by another 150,000 just because it's a sample. So with no misstatements, we would still have to have 150,000 of possible misstatement because at 5%, because it's a sample. Now, if there are errors found, it could be even more than that. That's what we're going to do next. Okay, so let's go to the most confusing thing you'll ever see in all of accounting. Incremental allowance. And I'm kicking myself for just not going ahead and making a table for this. Incremental allowance is if you find an error, so we have 2 of them here, right? We have 2 errors here. We have our 2 misstatements, 30,000, 10,000. So what we're going to do is reliability factor increments. And so the reliability factor increments, we're going to have overstatement 1 minus overstatement 0 minus 1, and that will give us the first increment. Now, I know it's very confusing, but I'll show you this second. Okay. So here's overstatement 1. We're going to subtract overstatement at 0, the reliability factor, and then minus 1 from it. Let's see here. So this was 375, 475, 475. Okay. So so 475 minus 3 minus 1 is 0.75. And I'll show you what we do this in a second. So that would be the first incremental. And again, I know this is confusing, but I'll show you what we do in a second. Let's go ahead and do overstatement 2 minus overstatement 1. We should do it up here. I wonder if that would be easier. Well, I'll go ahead and do it, then we'll. So overstatement 2 is 630 minus overstatement 1, which is 475. So the increment, and then minus 1. Copy this. Okay, so whatever that is. Five. And just for yucks, I'm going to go ahead and do the third one, even though we don't need it. Let's see where we go with that. Seven, 6. Oops. We really didn't have to do this one, but we don't have a third one. But just to give you an idea of what it would be, it'd be 0.46. Okay, now an obvious question is, okay, well, now what? We got these. What do we do with them? Okay, we're going to multiply this times the misstatements. And the largest misstatements first. Okay, so going up here to the misstatements. Which one's the largest?
$30,000.
Number 2.
So the first one will be 30,000. So you multiply this by, oops, what am I doing here? 22,500. I think that's right. And then we're going to take the second one, which is 10,000. Yep. equals 5,500. We don't have a third one. This one, well, this one isn't here at all, so you don't need it. You don't really need this one. I'm just going to delete it. So we'll have the total incremental allowance. Oops. Equals 28. Oops. So 22,500 for the first one, 5,500 for the second one. So the total incremental allowance is going to be 28. Thousand. Okay, so that's a yeah, so that's gonna look like this. So in here, this incremental allowance is gonna be another 28,000. And again, this is because there's misstatements. If there weren't any misstatements, we'd only have to have these two. But because there's misstatements, this incremental allowance is, look, if they find misstatements, that means it could be off by more. And so this will add to it. So the total amount that it could be off by would be the 40, the best estimate, the 150, which is just for sampling, and the 28, which is for any misstatements that we find. And that will tell us the total, the upper limit on misstatements. So I'm just going to copy these down. Oh, wait, what happened here? Something wrong. To do more things wrong. So these all together will be the upper limit. 218. I think it's 218. So this is what we call our upper limit on misstatements. So even though our best estimate is here, this is our best estimate. It could be off by as much as 218,000. So this is our upper limit on misstatement. And again, this incremental thing is kind of wacky. I think the next time I teach this, I'm going to go ahead and make an incremental table. I mean, there's no reason why you couldn't just make an incremental table based on those. You know, it's just this minus this one and, you know, minus one. And you could easily have an incremental table. I think I'll probably do that in the future just to. But anyway, this is the actual formula for doing that. Okay. Tell you what, why don't we go ahead and we'll work on, I'll let you guys work on this one on your own, but I think we'll do this first part together. And for number 6, and then, you take a break whenever you want. We'll come back and kind of put it all back together. So let's kind of go through these up here together. Okay, what do we do with this first one?
Divided by 5,000 by the book value.
Normally I would
Ignore
say,
it.
yeah, normally I say yes. This one we're going to ignore because this one we're not supposed to be able to find. This is an understatement. So, yeah, normally you would kind of do like the ratio estimation thing, but this one is an understatement. So this one we're not going to do anything with. The rejected misstatement is 0, and it's not really a misstatement at all. Oh boy, what did I do here? Let me goof this up. Hold on. And is it an incremental allowance? No, because it's not even an error really. It's not a misstatement at all. Okay, now going down to this one, this is an overstatement. So we're going to go ahead and do this one. Just like you said, we're going to divide them. Get space in here. So. Okay, so the projected value of this one is 75,000. And that would make the projected misstatement 25,000. Right, so of this 100,000 sample interval, I should say, 75,000 of it was okay. 25,000 of it was a misstatement. Now notice that there could be more things wrong in here because this only covered 20,000 of this. So there could be more things that are wrong in this interval. This will be in the incremental allowance. And now for the super tricky one. What do we do with this third one?
It's an understatement.
Yeah, this one is, well, it's gonna be an overstatement. They're overstating it. They're saying it's 108 and 95. But you'll notice something weird, and that is this. This one is larger. The value of it is larger than the interval. So, oops, that's not me. So this one, it's 100% sure this one was going to get picked because it was more than $100,000, and that's the beauty of this method, is that if there's something that's overstated, if it's overstated enough, there's 100% chance it'll get picked if it goes more than the interval, and that's what this is. However, when you start doing the incremental allowance, that interval could not get any worse. It covers the entire interval. So there is no incremental allowance when the item itself, the book value of the item, is larger than the interval. There is no incremental allowance. That interval is as misstated as it can be. So this one, we're going to switch gears here, and we're just going to get the actual misstatement, not the projected. This is actual. Which is 108,000 minus the 95,000. And that equals 13,000. So this will be our projected misstatement. It is not going to be in the incremental allowance. And again, that's kind of weird because nothing else could go wrong in this interval. This thing covers the entire interval. So we just take the actual misstatement. And it was actually misstated by 13,000. All right, this one down here, again, the same thing we did before. Zero divided by 112,000 is 0. Projected misstatement is 100,000. By the way, for this one, sometimes the books will say, if the balance is 0, the auditor should investigate as to why it's 0. You always investigate as to why it's 0. It doesn't matter what method you're using. You always investigate why something is off. So if it's, even though they say, investigate why it's 0, that's just a regular part of auditing. It's just part of your job. But you seem to stick that in there. But anyway, if it is 0, and if 0 is the correct amount that it should be, then the misstatement will be 100,000, and it'll be in the allowance. So the projected misstatement would be all those together. 138.
Could you step through like a scenario for that last one? It's just like a fraudulent entry for $12,000, and the audit value says like, hey, this doesn't exist.
Yeah, and it could be that, it could be something that they have hanging on the books that is not really there. For instance, if there's a dispute, or if something was wrong with a shipment, or they shipped the order to the wrong customer, and charged them, the 12,000, they returned it, but it's still sitting on the books, something like that. Those would be some scenarios that they'd have where really the customer doesn't own anything, but they're saying that they owe $12,000. It could be a fraudulent one that you find out that it was a fictitious sale or something like that. That's true too. It could be a fraud that they simply put on the books, hoping that you wouldn't pick that one, and that it was a fraudulent sale. It could be that also. But there's something along the lines of that. They have it on their books, and it doesn't match up with what the reality is. And again, you'll always look into those, because one of the questions would be, if it was a fraudulent sale, now it changes the audit, because then now you're okay. Well, I got to look for more of these. If there's
Right.
one, there could be more. So you would definitely look into it, no matter what method you're using. If you're using classical sampling and you ran into that, same thing. Why is it off by so much? And you will, and two, even just regular errors. You'll investigate as regular errors because you want to see why. What is
Right.
it? Is it something that's systematic? That's going on.
It's
Okay.
yeah, my brain just gets hung up on the fact that like there's potentially let's just say it's an issue of $12,000, but the weight of it is $100,000 misstatement potentially. So it's just
Yeah,
My brain can't wrap its head around that, like the difference in the magnitude, I guess.
yeah, and that's part of, well, and that's part of one of the reasons why, they will say, look into it. Obviously, you will. But this method though is sort of like, it's a ratio method, and you just pick one item and have it represent the entire sample. And that's just the method that it uses. And the larger the sample, the smaller the interval will be. So it also depends on, on that, how sure do you want to be. And you'll notice that this one is at 10%, which means you'll have a smaller sample size. And so, yeah, if you do run across errors, they can be exaggerated. Also, you got to remember, I made this, in auditing, when you do sampling, I can tell you that it usually either goes one way or the other. And then, you go through the entire sample, you don't find anything wrong, or you find all kinds of things wrong. And that's usually, that's just the way it seems to go. But, to do a reality, to have us go through, whatever, 50, 100 items or whatever, and have them all come out to be exactly the same isn't very fun. so that's why I make it a little more exciting by making, giving you the wacky stage. And by the way, this is exactly the format that was given on the CPA exam at least a couple of times. So it is in the realm of possibilities that you'll see something like this. But you notice that this is at the 10% level, so you're not quite as sure as the 95% level, whatever that. And you'll notice that, let's say the interval is 100,000. The book accounts receivable is 2 million. So what is that, 20 items? So they're only picking 20 items to project it over. So yeah, anything that's off is going to be magnified because of the low number of items picked.
Got it. Thank you.
Yeah, so good. See if you can calculate these second two here. You can calculate B and C. And then we'll say be back at maybe back at we'll kind of go over it maybe at 7:10. If you're still working on it at 7:10, we'll take one more time. Yeah, and by the way, remember that this is at the 10% level. So you're going to use, well, whatever the table is, you're going to use a 10% column rather than the 5%.
You're on mute.
Yeah, I'm sorry, I wasn't talking. I should have been. Yeah, so 138, and then the incremental allowance was 231. I'm sorry, basic precision was 231. 69. Okay. So that is the method. Now, this one is obviously off by quite a bit. When you think about it, it's the projected that it's off by 438,000 when the total amount is only 2 million. It's quite a big chunk. You'd think that that'd be material, most likely, but question on that? And again, this incremental allowance is kind of a wacky thing. The idea behind it is fairly, kind of common sense. That is, if there's errors, if you find any errors, that means that errors can exist, and that it's, that if that there's more a bigger likelihood that there's more errors in there. So that's the incremental allowance about. The calculations for it are a little bit quirky. But you'll notice that table too, though, this method is really supposed to be only used for when you don't think there's going to be too many errors. And I say that because you look at this table, it only goes down to 5. So that tells you that, this is generally not going to be used for something that has, say, 30 errors in it. Not sharing anymore. Yeah, I'm sorry. So this table up here, it only goes up to 5 misstatements. So this is when you doubt that there's going to be too many errors in it. Then this method works well. If you do have a lot of errors in it, then you run into a problem. And we'll come down here to number 7, the advantages and disadvantages, and just kind of go over them. By the way, this is one of those things that they do test in the multiple choice questions. A lot of times on the CPA exam, they'll have, what are the advantages of this or that type of a method? When should this method be used? Those sort of questions. Okay, advantages. The big advantage here, and this is not obvious from what we did, but a smaller sample size for populations that have a lower occurrence of misstatements. If you don't think there's going to be very many misstatements, you don't expect misstatements, then you can get usually a lot of times a lot smaller sample size, and I mean like half as much. The big, a big chunk of the expense of an audit is the testing. Probably half the dollar amounts is in the testing. So if you can reduce that, any portion of that by 1/2, well, that's a great thing. So the big thing about this method is that it reduces the sample size. Automatic stratification, we're going to talk about this in a little bit here, but not just yet. And this is that you like to look at big things rather than small things. If you have a $50 item and a $50,000 item, you probably don't even care if the $50 item is completely off, but the $50,000 item is going to get your attention. That's what you want to look at. This method automatically picks that. The higher dollar amounts are going to be more likely to be picked. And at a certain point, it's 100% sure it's going to be picked. And again, this last one, probably not obvious from what we just did, but it is generally easier to use. The disadvantage, and this is the huge one, cannot be used for understatements. And this is the very big drawback to it. Yeah, so it cannot be used for understatements. And the sample size is not easily expanded. You'll notice that this is a little bit different than classical sampling in that the sample size determines the interval. So if you change the sample size, so let's say you come up with, well, like the results we just got, they're off by quite a bit. You go, well, I want to be a little more sure, you know, of my number. I'm going to take a bigger sample. It's really hard to do that with this method. You know, why? Well, when you change the sample size, it changes the interval. It changes the items you pick. So there is a problem. So if you run into a problem, I should say, then you have a second problem. The problem is, how do you expand the sample? A lot of times you'll switch over to the classical sampling at that point, because again, if you change that sample size, that also changes the items that you pick. So in that way, you know, you can't have some difficulty with it. Okay, classical sampling, as you may have figured out, a lot of times they are kind of just the opposite of what you see up here. Smaller sample size if they have a higher occurrence of misstatements. So if you have a lot of misstatements, you'll use this method, the classical sampling. Items with negative or zero balances, as we found out, it's fine with those. So if it's possible to have negative balance. For instance, if you're going to accounts receivable. Okay, well, what if somebody returned some stuff and you didn't, you know, for whatever reason, didn't get on the books? It's possible that there's a negative balance in the accounts receivable. In other words, it's a payable. You know, it should be reclassified. But as far as getting the overall value of the population, you probably want to leave that in there, because that will tell you what the real value of the population is. So even negative numbers, it doesn't bother this thing. You know, put a negative number into, you know, the other proportional size, you don't know really what to do with it. You know, zero is one thing, but put in a negative number, you know, you don't know what that's gonna. It has difficulty with it. And I'll be honest with you, I'm not even sure what you do with it. I would guess you put it in as a zero, but I guess it depends how much is understated. Okay, the really great thing is this. Can be used for understatements or overstatements. So classical sampling. This is the stuff we already covered, the mean per unit. Oh, the caps lock's on. It's still on. So classical sampling, you know, these ones we already covered that we're talking about here, and they can be used for understatements or overstatements. Sample size can be easily expanded. It's easy to go grab some more items and audit to a higher level. Standard deviation must be calculated to determine sample size before you can do the sample size. So this is one of those things you have to, it's kind of like the chicken and the egg thing. You're trying to see what the deviation is in the sample, but you have to have a deviation before you can even find the sample size you need to pick. So you either do a preliminary sample or maybe use it last year. All right, this is an important one too. Auditing standards do not advocate one technique as being better than the other. They are simply used in different circumstances. Back in my day, when I was going through, it was kind of probably the proportional size was really being pushed and saying, okay, this is our, you know, this is our method. This isn't like the classical sampling. Classical sampling is for, weighing chickens or something. But this is just for auditing. So, this is the method that's the best. Well, it's best in some circumstances. Low expected errors and only for overstatements. So if those two things are met, then it's probably better. But yeah, so it's not for all circumstances, obviously. All right. Any question on that? Okay, we'll start in on the next. Let's save this. The next sampling, the last sampling one we're going to do, the overview and test the controls. And this one, the first few pages are just kind of on general ideas behind sampling. And yeah, in number 5, we go into test the controls. Okay. The general purpose of sampling. Sample of items and project it over the entire population. Okay, selecting a sample. A random sample is the best. Those of you that had sample your statistics class, why is a random sample considered to be the best one? What's good about a random sample? Do you guys have statistics or no? That was a previous course semester.
I did like 10 years ago, so
Okay,
it's a little rough.
You want a random sample because it's going to be unbiased. It's the most objective, unbiased sample that it will best represent the population as a whole. So it's unbiased. It's the best representation is a population as a whole. And by the way, that also leads me to one more thing, though. Some people think that when you do auditing, oh, you're looking for misstatements or problems or whatever. Yeah, I mean, yeah, you do look for those things, but that's really not what you're doing. You're really trying to find the best representation of that population. When I would do auditing, I was an internal auditor. An internal auditor, we would look for errors. We would look for problems. We would do some sampling to see, if the numbers were misstated or not. But we'd also were looking for all of the misstatements. We would look for things that they wouldn't deem as being material for the external auditors. And I would go into files. And I remember this back when they used to have paper files, and I'd look for the files that were all messed up. Files that had things stapled to them and stuff hanging out and sticky notes and all that kind of stuff. And I'd pull all those. Not random at all. I would find a lot of errors doing that because those were usually the problem, where the problems lie, but not a very biased sample. And then I'm actually looking for those things that are bad. Whereas the external auditors are really not. Their goal is not necessarily, hey, let's find everything that's wrong. Their goal is to see, are these being materially misstated? And the sample will hopefully reflect on the population as a whole. Systematic sampling. That's a example. I'll give you an example, give you an idea. It's for example, pick every 10th item. And this might be used if you have a real problem trying to pick the random sample. A random sample, you can use either a table or a computer, random numbers table or computer. But systematic sampling is pick every 10th item or something like that. And the reason why this is, I'll say this is second best. How about that? Is that there may be things that repeat that are missed in the you every 10th item. For instance, if there's some item that's saying that something that only happens on the 7th or whatever, it's possible that you never find that. Again, there's random sample, which is the best. This I would say is probably the second best. And you can have a random start, random between 1 and 9 or whatever, and then go on from there. So this is the second one. Oops. Haphazard. Is it like blindly picking items? I actually did this once. It was one of the strangest things I ever did. I was doing an audit at US Steel, and they were doing this invoicing stuff. And US Steel they used to have thousands of people working in the offices at US Steel. Back before they had calculators and all this kind of stuff, they had people with typewriters and adding machines and all that kind of stuff. Well, as computers came out and all that stuff, the company shrank, and this cell shrank. So there's like tons of huge buildings that are just unoccupied in Gary, Indiana, at the steel mill there. So if you want to have an office there, you could have it anywhere. You could have a huge spread out thing. So this really giant building, it was doing this invoicing, and pretty much everybody, about I don't know, 7 or 8 people were at this one huge office space. Okay, so I'm doing all this stuff. And then there was these special invoices that I had to, that had special considerations of how they were shipped. And I had to get a sample of those. They said, oh, you got to go down the hall, and that's where the person doing it. So I'm walking down this hall, and I can hear voices just talking, laughing, I come in, and it's one woman is there, and she's obviously a schizophrenic. She's just talking to herself, and I say, okay, I'm here to, I picked these items from the sample, that I want to pick, and she just kind of looks at me, doesn't respond, and then she starts saying something. I'm like, I'm sorry. And it was so strange, and it was just like completely taken back by it. So I after about 10 minutes of just awkwardly trying to, say, look, I need these, I need to find these, and just nothing getting up. So I go back down the hall, and I'm like, what's going on? And they said, well, yeah, she's a schizophrenic, and she's completely normal when she takes her medicine, but she's not taking her medicine. And it was a union thing that the company couldn't force her to take her medicine. And I guess she was going to be there like maybe another year and then retire. So you know, so I got my boss. I said, look, I don't know what to do. I said, I can't communicate it. And I started going through some of the boxes and I couldn't figure out, couldn't make heads or tails out of any of them. That I don't know how they were filed. I don't know, you know, you could not figure it out. And I just talked to her, how are these, and just completely nothing coming back. So you just smile and stare at me, or just start talking about something. And so I didn't know what to do. So I called my supervisor. That look, I have no idea what to do with this. This is I don't know what. So he said, okay, he said, I tell you what, you need 40 items. He said, just go through and get whatever 10 boxes, take 4 items out of each of those boxes and test them. Well, that's what I did. Haphazard, I don't know if there was any order to them. There could have been, but I couldn't figure it out if there was. And so I did. That's what I did. And so that was a haphazard audit. And the punchline to it, they were all perfect. I know now a little bit more about schizophrenia, and that generally his people that are really smart and they're completely competent, can be completely competent in what they're doing. And she certainly was. There was nothing wrong with any of the stuff that she did. And she was doing the hardest of the invoices. So, but I tell you, it really shook me. It haunted me for a while, and I remember it took me like a couple of days to tell my wife, I gotta tell you something. You're not gonna believe this, but okay, block is when you take an entire block of a sample. Let me give you an example for this one. Block selection is, the joke is block selection is for block heads. What would be the problem of taking all of October's sales orders as your sample instead of taking some throughout the year? The obvious problem is, not all errors happen in October. And a lot of times fraud happens in December when they're not going to make their numbers. So taking a block sample is, the joke is block samples are for block heads. But anyway, it's when you take an entire block and have that represent it's that the count as a whole. Okay, stratification. One thing we didn't talk about before. I don't think we talked about this, did we? I don't think so. Okay. So looking at our items here. So there's a total of 5,000 whatever accounts. And these are the dollar amounts for the first 10. Which of these accounts are you most interested in?
The one with the bigger amount?
Yep. Probably these two are probably the ones that you're going to want to look at. Yeah. Yeah. I know, I'm just gonna get rid of it. Yeah, probably these two. This is a large one here, and you'll notice that there's some, like for instance, this one, the 3, number 3 at $28. If that whole thing was misstated, you probably wouldn't care too much about it if you're doing regular classical sampling anyways. Which account is most likely to be fraud?
Number 6.
Yep. One of the weird things about fraud is a lot of times people that do it will do it at nice round numbers. It's very rare to get nice round numbers for regular transactions. They're almost always, you never get 25,000. It's $25,231.12. Those are the usual numbers. For whatever reason, a lot of times people commit fraud, they'll do it in nice big round numbers. Okay, stratification. So a lot of times you'll have a stratification that you'll break this up into, say, 3 samples or 3 different categories. And you might say, okay, over $10,000, we'll take 100% of those. So if it's over $10,000, take 100%. And from, say, 1,000 to 10,000, maybe you take 20%. Under 1,000, maybe you take 5%. So sometimes you might go ahead and break these up into different category, different layers, stratuses or strati, because you want to get all of these at a bigger dollar amount. These are the next most important ones, and then down here, isn't that those aren't important? It's just that they're not. They usually don't make up as big of a total, and a lot of times, if one of these is misstated, it may not have any bearing on the audit at all, especially if you're doing classical sampling. So this is stratification. Okay. Let's jump into 3 here. Attribute sampling. This is sampling that's usually done for tests of controls. These are yes, no tests. Test of controls, you remember that's to yes, no test. So, if a manager has to sign every purchase order, you take the purchase orders, you see if a manager signed off on it, it's either yes or no. Signed by a manager, it's yes. If there's no manager signature, it's a no. So it's yes or no. And this is a binomial, and if you not spend like 10 years for you something, but binomials, if you actually do the mathematical calculations, they can get pretty extensive pretty quickly. But this is one of those ones that they use to estimate. They use the normal distribution. I'll show you. It looks like this. The central limit theorem. The central limit theorem says that every distribution will eventually turn into a normal distribution. And so it's sort of like this. So it's like flipping a coin. One flip. Your choices are heads or tails. And they should be equal. Two flips. They could be heads, heads. They could be heads, tails. Could be tails, heads. Oops. Or they could be tails, tails. Okay, now notice, if you don't care about the order, that those two are the same. So it kind of looks like this. Heads, heads. Heads, tails, and if you don't worry about the order, which we don't, you know, these are all have 25% chance. But if you don't care about the order, this one would be 0.25. A heads and a tail or tail and a heads would be 0.50, and this would be 0.25. So already this would start to look like, even after the second flip, it would start to look like a normal distribution. So this is what we use when we estimate attribute sampling. Because after any distribution, or I mean, any, I'm not a status guy, but any distribution, or most of them anyways, after repeated use will go into a normal distribution, which is good because the normal distribution is real easy to use, and that's why we do it that way. Whereas if we were actually going to crank out the numbers of a binomial, it would be it could be a lot of work. Okay. Discovery sampling. Okay, this is to see the statements. Okay, discovery sample is based on discovered items based on a number of samples, usually the number of items without a misstatement. It's a little bit different than our other kind of sampling, and it says, okay, for instance, the signature on the check. You say, okay, I want to see what do they have a problem with the signature on the check? You can go through a certain number of them. There's actually tables for this. You go through and say, okay, if I pick 52 items and I haven't found an error, then I'm 6.2% sure that there's no errors in the population. And the more items you take without an error, the more assurance that you have that there aren't any in the population. So that's one way that's used a lot of times, especially looking for things like fraud and stuff like that. And that there's a certain number that you go through, and the more you go through without finding anything, the more assurance you have. And that's common sense. But it's also, there's also statistical tables in that will tell you, how sure you can be about it, given the number of items you take. Classical sampling, we already talked about that. Yeah, we talked about both these. So this is the something per unit, ratio estimation, and difference estimation. Monetary sampling, monetary unit sampling, we just did this. Dual purpose. Let me give you an example. Let's take let's say we're doing a ratio estimation. I should say something on these two here. These are to test dollar amounts. Okay, so coming down here, so the test control is you pick 100 items, you do this first. So you do the test controls first, pick 100 items. Now you need 500 items for the ratio estimation. So, sorry about that. So here's the thing. So you have these, so the test controls, you have 100 items. Test controls are usually more involved. But for substance testing, like we did for the ratio estimation, or I'm so sorry. So yeah, you do all this testing for the controls, and these can be really involved. So for instance, let's say purchase order. Is there the signature of the manager on there? Is the item on the approved item list? Is the vendor on the approved vendor list? Is the all these different things that you can check for? You literally have 20 items. Now, you pick a sample of 100 items. It would only take 1/100th of a second to write down the dollar amount when you're doing that. And that you could use in your substantive testing, in this case, the ratio estimation thing. So what we could do is, instead of picking 500 items needed for the second one, we'd only pick how many? An additional 400. So 100 items would be dual purpose. And we need to pick 400 more items for this. So we can use the same 100 items, and then we just have to pick the additional 400 items down here. Any question on that? Okay, well, that is probably enough for this week. And again, I did put the test out there. That you can turn in the test. Do you guys have any questions on the test? Any question on any of the problems on the test?
No.
No? Okay. All right. Well, if you do, you can go ahead and email me. So anyway, we'll talk again next week. So next week we should finish up the this handout. And we'll start on accounts receivable. Next time. Okay. Well, have a good night, guys.
Thank you so
Thank
much.
you.
Have a good evening.
Good night.
Good night.